What's up, everyone? How you doing? It's Ryan Lee back again with Cash Flow Tactics, the Financial Freedom. Now, this is your 4-step formula that you can use in your life, in your financial plan, to achieve financial freedom in 10 years or less. Now, the reason we call it a formula, guys, is it's really simple. 1 plus 1 equals 2 every single time. When you know the rules around creating wealth, I can show you a formula how to do it systematically, predictably, and sustainably over time. And I've done this with several clients that I've worked with. I've done it in my own life. I know it works. But financial freedom is simple. When your cash flow from your assets exceeds your expenses, you are financially free. The entire purpose of this formula is to show you what is not working, what does work, and how to apply it in your life. Today, what we're doing is we're talking about the cash flow banking strategy. This is the ultimate financial tool of the wealthy. Now, I remember when I learned this for the first time, I was dumbstruck. I was literally just my jaw on the floor because I didn't know life insurance could be used as a bank. So what we're going to do is we're going to be diving a little bit deeper into this, and this is probably one of my favorite ones that we'll share today. And so I'm going to share with you a little bit of a story on this. But before I do that, guys, this financial freedom formula represents years of study, hundreds of thousands of dollars of investments made on my end and on the other members who are part of this team. And guys, it works. It's worked in all of our lives. It's worked in several clients' lives. Last year, we assisted clients in over 100 properties, helping them buy properties that cash flow passively and building a financial plan geared towards financial freedom. Guys, it works. So if you want a copy of this formula for yourself, 2 ways to get it. Text cash flow to 797979. Cash flow, one word, to 797979, or go to cashflowtactics.com/mind map. Okay. So guys, get this mind map for yourself, and you're going to get access to all of these tools that I share in here. But we're going to be diving into step number 4, the cash flow banking system. So today we're on follow the money trail. Okay, now this is probably one of my favorites. Whoops. Let's see if I can get that back. There we go. All right, here we go. Let's see. Come on. Let's make it. There we go. All right, now let's get back in. Okay, follow the money trail. So I do a lot of real estate, and I'm trying to teach my kids from a young age why I do real estate, the process of doing real estate. So anytime I do real estate in a local market, I usually take one of my sons or my daughter to do the process with me. So I take them to the bank. I've taken them to collect rent before. I take them to do rehab and renovation. I get them involved with the process, and this is our way of teaching our children how this entire strategy works. So not too long ago, I was at the bank and I was taking some money in, and at the bank they have that bowl of suckers, okay? And my son, who's 5, he'll come with me to do the real estate just to get a sucker. This kid loves his suckers, and so he's sitting in the back of the truck, and I give the teller my information. She's putting the money in the bank, and my son asked for a sucker, and so of course I say, yep, you get to have a sucker because he came with me, and he asked, Dad, why do banks have suckers? And I thought to myself, that's a really good question. Why do banks have suckers? So if you've ever been to a bank, it's likely that you've been able to get a sucker for yourself or for a kid. And here's the reason why. In every single bank, there are cameras, right? At every corner, every angle, watching every single detail that happens in the bank. And once you understand what I'm going to share with you today, I have to imagine that the owners of the bank, the operators of the bank, are standing behind these cameras watching the people using their system and laughing. They're laughing because we are suckers. They give us a sucker for us to give them our money so they can achieve astronomical results using this very, very simple system. So guys, what I'm going to share with you today is mind-blowing, and it's going to revolutionize the way you handle and deal with finances going forward. So banks have suckers because we put money in banks, and we're suckers if we don't understand how this works. So when we put money into a bank, banks have 3 rules that they follow. There's 3 things that they want with our money, and this is the model of all banks. Okay, so the 3 rules of banking are, number 1, cash flow, number 2, leverage, and number 3, velocity. To demonstrate this, I'm going to flip over to my drawing board here, and I'm going to show you just a quick example of the math behind this, right? So let's say you put money into a bank, right? You make a deposit. And last time we talked about why we might make deposits into a bank, right? But we want our money to be safe and liquid. So we put money into a bank. And let's say, just in this example, let's say that we're willing to put in $10,000 into the bank, okay? So we put our $10,000 into the bank, and the bank comes back and they give us our little promise. They say, hey, guess what? We're going to keep your money safe and we're going to keep it liquid, right? So when you get ready to come back, now just, don't everyone come back all at the same time, but when you get ready to come back and use your money, it's here for you. Now, the 3 rules of banks are, number 1, cash flow, right? So they entice us to put our money in the bank and they trade our money for a sucker. Right? And in this example, we're going to say that they're paying us an interest rate, even though they don't really pay an interest rate. But let's say that they're willing to pay us 1%. Okay, so that might be a little bit, exciting for today. Most banks aren't paying anything, but let's say they're paying 1%. Now, when you put your $10,000 in the bank, what does the bank do with it? Do they write a little note on your money and say, hey, this is client A's money. Let's put it back in the safe. And when he or she comes back, we'll have it here for him, just like we promised. No. The second rule of banking is velocity. Excuse me, not velocity, leverage. Now, leverage is the most powerful tool in all of finance if it's used appropriately, right? And what this really means is the bank is taking your $10,000, my $10,000, whoever's money is put in there, and they're then using that money for all kinds of purposes. They might lend on a mortgage. They might lend on a boat. They might lend on a car. But the bank is using our money to run their business. And in exchange for that, they're giving us a few very hollow promises that our money's safe and our money is liquid, and they might pay us a rate of return. Now, here's the astronomical part. Let's just say on average that the bank can earn a 10% rate of return on these investments. Now, I know mortgages are a little bit lower, but let's just say they're earning 10% just to keep our math safe and easy and easy to calculate. Now, if we look at this, what is the bank's rate of return? How much money are they earning in this transaction, right? Most people would say, hey, it's 10 minus 1. I'm earning 1%, the bank's earning 10%, so they must be earning 9%. Now, that's not bad, right? I mean, I think most people would flip out and be pretty excited if they could earn an annual compounding rate of return of 9%, but here's the real math behind it, okay? The bank gives us $100. In exchange for that $100, they're able to earn $1,000, right? They take $10,000, they earn 10%, so they earn $1,000. So remember, 1% of $10,000 is $100, and that's what they pay to us in interest. On our $10,000, they then go out and lend it. They earn a 10% rate of return, so they earn $1,000 of interest, and they do this in a year period of time. The bank's rate of return is not 9%, it is 900%. The bank is not using their money, they're using our money, and they are using this money to operate their entire business. And so last but not least, the third rule of banking is a matter of velocity. If you can earn a 900% rate of return, you do it all day long, as fast as you possibly can, over and over and over again. The banking model is astronomically crazy profitable for banks. And so going back here to the beginning, why do banks have suckers at the beginning of their, in every single bank? It's because you and I who don't understand the math, we are literally suckers funding the entire Wall Street financial industry with our deposits. And we're doing this for a shallow, hollow promise that our money will be safe, and we get zero back for it in the terms of a rate of return. So the last part about this is what I'm going to share with you on the next video is I'm going to share with you how you can take this exact same strategy that a bank is using and you can apply it in your own personal life. You can literally be the bank and use other people's money to achieve amazing results. What if you could have your money doing 2 things at once, right? What if you could have your money compounding and growing, which is the ultimate goal of savings, but at the same time, you could leverage the value of that money, just like a bank leverages our deposits. You could leverage the value of that money to achieve your short-term goals. So for me, over the last 10 years, I have used my cash value in my life insurance policies to buy over 20 pieces of real estate. I've used the cash value in my life insurance policy to fund vacations, to do remodels on my primary residence, to pay for medical bills. I've done all of this, all with the assurance, all with the knowledge, all with the guarantee that my money is still compounding and growing. I'm achieving 2 things at once. Just like a bank, I'm leveraging the value of my money, but achieving long-term goals and short-term goals with the exact same dollar. Imagine if you could take the same strategy in your life and make your money more effective. The science that we teach, the formula that we teach here at Cashflow Tactics, I call it the science of collapsing time. When you understand how these principles work, you can take what takes most people 30 to 40 years to achieve in their financial plan and do it in a fraction of the time. You can do it in 10 years or less. It's just a matter of playing the game by a different set of rules, a set of rules that is more empowering and more impactful to your financial goals. So guys, join me on the next video. And if you haven't already, text cash flow to 797979 so you can get your own copy of this mind map. I look forward to talking to you on the next video, and we'll go from there. Thanks, guys.